This is ShadowQuant, Stocks, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 21, 2026, and this is the After Hours session. Now, let's get into it. We are in a state of fracture. The S&P 500 is sliding, the VIX is spiking into fear territory, and the traditional bonds between growth and value playbook has completely unraveled. We're looking at a market where defensive rotation isn't just a preference, it's a mandate. Let's look at the board. Before we dissect the move, let's check the calendar. For today, July 21, 2026, the eyes are on the financial sector's health. BlackRock reports at 8 o'clock MET, estimated earnings per share $12.49. Ally Financial follows shortly after, estimated $1.24, and BNY Mellon rounds out the trio at $2.16. Why it matters? With the yield curve flattening and small caps under pressure, these earnings are the stress test for credit availability. If BlackRock guides conservatively, it validates the fear we're seeing in the VIX. If they surprise, we might see a flash rally in the financial sector. That's your macro catalyst for the opening bell.
And the real story there is whether BlackRock acknowledges the liquidity squeeze in lower-tier corporate debt. A direct consequence of that plus 0.39 pp flattening spread.
Here is the snapshot. Broad indices are mixed to weak, but the divergence is screaming. SPY is at $742.09, down minus 0.16%, trapped near the bottom of its 10-day range. QQQ is holding its ground at $696.06, plus 0.1%, while the Dow drags at $517.94, minus 0.55%. The Russell 2000 is testing its knees at $292.31, down minus 0.59%. And the VIX, it's jumping plus 2.4 points to 18.77. We've got headlines moving names, but the macro backdrop is defining the direction. Let's break down the sentiment first. It's not just a spike, it's a regime change. The VIX hitting 18.77 pushes us squarely into the fear quadrant. Usually, you see this kind of volatility expansion during black swan events, but here, it's driven by a slow bleed of confidence. The spread between the S&P 500 at $742.09 and the Nasdaq at $696.06 tells the truth. Broad equity sentiment is deteriorating, but mega-cap tech is trying to hang on by its fingernails. Look at the sentiment scores inside that tech basket. NVDA is still posting a bullish plus 0.43, acting as the lone anchor. But look at Google at 0.22, and MS, MSK, MWG, and MWO all stuck at 0.25. The market isn't selling tech, it's picking apart the narrative. Retail is nervous, yes, but this institutional hedging is reacting to the realization that the AI premium might be overextended without broader earnings support.
I'm looking at the tape pulse, and the tape is ugly. SPY is at $742.09, which sounds fine until you remember the open was $747.06. We open high and walk down to the lower bound of our 10-day range, $739.51. That is a textbook breakdown of intraday momentum, but the real structural damage is in the small caps. IWM is at $292.31, sitting perilously close to the 10-day low of $290.68. Yesterday's low was $292.18. We barely cleared it and now we're back at it. Liquidity is drying up in the Russell. Meanwhile, QQQ is hovering right at $696.06, essentially resting on the $695.51 level from yesterday. If that $695 support breaks, we aren't talking about a minor dip. We're talking about a retest of the 10-day low at $686.76. The technical structure is fragile. We are lower highs, lower lows across the board, except for that one narrow band of AI names.
Technically, grid is seeing the symptoms, but I'm diagnosing the disease. This isn't just momentum fading, it's a fundamental repricing of duration risk. We have CPI at 3.46% and core PCE at 3.41%. Both are stubbornly above the Fed's 2% target. What does that do? It crushes the present value of future cash flows. That is why the healthcare sector is down minus 1.14%, and the utilities sector is down minus 0.51%. Healthcare and utilities are long-duration assets. They get hammered when real yields don't cooperate. Look at Danaher, DHR. It reported strong Q2 earnings and raised full-year guidance, yet it gapped down minus 15%. That is not a company problem. That is a multiple compression problem. Investors are saying, we don't care about your growth guidance if the cost of capital keeps rising. Conversely, the energy sector is up plus 0.45% today and plus 2.11% for the week. Why? Because energy is a current cash flow business. It doesn't need a discounted terminal value to justify its price. The market is fleeing complexity for simplicity.
And therein lies the trap, CIPHER. You're calling it value. I'm calling it a defensive retreat into a shrinking pool of liquidity. The VIX at 18.77 is the warning siren. When volatility expands like this, correlations converge. Right now, tech is decoupled because NVDA, MRVL, and MU are propping up the index, but that insulation is artificial. Once the VIX sustains above 18, even quality tech faces margin compression. And look at the yield curve. 10-year at 4.6% against a 2-year at 4.21%, giving us that tight plus 0.39 pp spread. That flattening is suffocating bank margins in the financial sector, which is down minus 0.39%, and it's strangling the highly leveraged small caps in IWM. We aren't seeing a healthy rotation. We're seeing a forced deleveraging event. The flight to safety is overcrowding in energy and real estate. The real estate sector minus 0.42% today, but plus 1.19% for the week, which makes those sectors extremely vulnerable to a sudden liquidity shock. If the VIX sticks above 18.77 tonight, those green sectors are prime targets for a mean reversion snapback.
So we have a fight between fundamental derating and technical exhaustion. Let's zoom in on the sector leaders and laggards to see who is actually winning this war. First, let's talk about the laggard, healthcare and the broader rate-sensitive complex.
The healthcare sector is technically broken. At $159.25, down minus 1.14%, it has lost all upward momentum. There are no buy walls here. The moving averages are curling downward, and with Agio down minus 12.8% on trial results, the overhead resistance is loaded with trapped buyers, unless we see a decisive close back above $162. The path of least resistance is down toward the next support zone around $155. Same story for the utilities sector at $44.94. It's drifting lower, minus 0.51%, and every bounce is getting sold into by algo traders chasing the yield curve signal.
Grid is right on the price action, but let's talk about the flows. In the healthcare sector, you're seeing institutional desks trim positions ahead of the CPI/PCE readings. They aren't exiting the sector entirely, they're just reducing duration. But look at the energy sector. The flows are massive. Capital is rotating out of speculative biotech and into integrated oil majors. It's a pure risk parity adjustment. Traders are buying the energy sector not because oil prices are skyrocketing, but because it's the only sector providing a hedge against the 3.46% CPI print. The money isn't going to zero, it's going to survival.
But CIPHER, consider the concentration risk. If everyone piles into the energy sector and consumer staples for safety, who is left holding the bag when the market decides to rebound? The liquidity in those defensive names is thinner than it appears. We saw it with Goro up nearly 300% on absurd volume. That's noise. But we also saw FNGA crash 95% on 6.4 million shares. Extreme volatility in the margins suggests that when the VIX spikes, the bid-ask spreads widen everywhere. You think you're safe in the energy sector, but if the VIX runs to 20, even energy gets hit by margin calls. The risk isn't just directional, it's liquidity fragmentation.
Let's pivot to the anomaly in the tech space. Triple Q is green, plus 0.1% at $696.06, while the broader market bleeds. How do we interpret this divergence?
It's a quality flight, but it's fraying. Look at the sentiment data again. NVDA is at plus 0.43, MRVL and MU are positive, but the second tier, Google, MS, the software plays, are all deeply bearish, around 0.25. The market is buying the AI infrastructure thesis and selling the AI application thesis. It's a very narrow consensus. Retail traders are hesitant to chase the big caps because the VIX is creeping up, so the buying is coming from institutions rebalancing factor exposures. They are buying volatility in the NDX while shorting beta elsewhere. It's not bullish conviction. It's statistical arbitrage playing out in real time.
Statistically, Triple Q is walking a razor's edge. $696.06 is basically the floor. The 10-day range low is $686.76. If Triple Q closes below $695 tonight, which it nearly did at $695.51 yesterday, we trigger a cascade of stop losses. The technical setup for the technology sector is tricky because it's flat today at $175.71, but down minus 3.7% for the week. That weekly candle is red and it's getting longer. The daily green is a trap. It looks stable, but the volume profile shows declining participation on the upsides. Every rally in the technology sector is being met with supply. Until we see a volume-backed break above $178, the technical bias remains bearish.
Grid misses the earnings catalyst driving this. The reason Triple Q is holding while the technology sector is struggling is that Triple Q includes semiconductors, which are reporting solid numbers, whereas the broader the technology sector component list is heavy on SaaS and ad tech, which are facing headwinds from the strong dollar, trade-weighted dollar at 120.53. Multinational tech revenues are getting squeezed by translation effects. So Triple Q is green because it's shielded by hardware demand, while the technology sector is bleeding because software margins are getting crushed by currency and rate pressures. It's a fundamental split, not just technical.
Finally, let's look at the small cap distress signal. IWM is at $292.31, down minus 0.59%, testing the $290.68 low. Is this the start of a deeper correction for the Russell?
It's the canary in the coal mine. Small caps are leveraged floating rate debt. With the 10-year at 4.6% and the curve flattening, their refinancing costs are exploding. IWM at $292.31 is dangerous because it's approaching the psychological $290 handle. If it breaks, we see algorithmic selling accelerate. The volume in names like Goro and Effenga shows that micro-cap liquidity is evaporating. This isn't just a risk-off move, it's a liquidity crunch signal. If IWM loses $290, expect the financial sector to weaken further as banks provision for bad loans in the small business lending book.
Structurally, IWM is forming a descending triangle on the daily chart. Lower highs since late June and now testing the lower boundary. There's no support above $292.31. The next logical technical level is the June low cluster around $288. If we lose $290, we gap down. The RSI is diverging negatively. Price is making lower lows. But momentum is weakening slower, which usually precedes a sharp acceleration downward. I'd bet against any bounce attempts here unless we see a surge in volume that isn't associated with single name M and a news.
The sentiment in the small cap sphere is outright panic. Put/call ratios in the IWM options chain are spiking. Traders are paying up for tail risk protection. It's not just fear, it's dread. When retail stops buying dips in the Russell and starts buying puts, the floor disappears. The divergence between SPY holding $742 and IWM crumbling at $292 proves that capital is abandoning size. Large caps have balance sheets, small caps have bills, and right now the bill collectors are winning.
We've got a lot of moving parts here. Let's tie it together.
CIPHER highlighted the fundamental pressure on duration. CPI at 3.46%, crushing the healthcare sector and the utilities sector. And Pulse noted that sentiment has shifted from cautious to fearful as the VIX breached 18.77. Grid confirmed that technically, we are breaking key support in IWM at $292.31, and QQQ is relying on a narrow band of AI names to hold QQQ at $696.06. The synthesis is clear. The market is undergoing a forced deleveraging event. Cash flow visibility is the only metric that matters right now. The energy sector is leading because it pays dividends today, not tomorrow. IWM is failing because its future is discounted heavily by the 4.6% yield. The strategy for this environment is not to guess the bottom, but to respect the hierarchy of liquidity. Stick to the sectors with current cash flows, avoid the long-duration traps, and watch the VIX. If 18.77 holds, the pain continues. If it compresses, we get a relief rally in the oversold names. Until then, risk management is paramount.
That brings us to the takeaway. 1. Volatility is the new baseline, with the VIX at 18.77 signaling institutional fear. 2. The market is bifurcated. Defensive value, the energy sector, is thriving while rate-sensitive growth, the healthcare sector, the utilities sector, collapses under fundamental pressure. 3. Technical support is thinning, with IWM testing critical lows at $292.31 and QQQ clinging to $696.06 on narrow leadership. Tomorrow, we watch BlackRock's earnings and whether the VIX sustains this fear regime or contracts. Stay disciplined, watch the levels, and keep your guard up. This is ShadowQuant Equities Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.